Hi, everyone. Welcome to another Dolphin Financial Radio show. Today, we're going to be talking about one of the most popular conversations, or the one I seem to be having the most with people that are looking to retire, and that is, should I delay my Social Security and spend down my IRA, my 401k, my qualified assets in order to do so? You know, we do a lot of shows on Social Security. I'll put the list up here. We do a lot of shows on Social Security, always discussing different tactics and strategies. And a lot of times it makes sense to delay. And people say, well, if I delay, where's my money going to come from? How am I going to live? And that's really what we're going to be talking about. Does it make sense to delay Social Security? And if so, should you pull money from your IRA to live? Now, Tony Shore is in the house. There he is. Tony. Yes, we're talking about Social Security yet again. You know, we talked about this a lot lately, and they are our most popular topic. And today we're going to be talking about, does it make sense to withdraw from your retirement savings in order to delay filing for Social Security? You know, this is a big question, people.
Do I need to have a Social Security number first?
When we're talking about general population here, people that are legally here, Tony, the people that work for a living.
Oh, do you know your Social Security number by heart, Dan?
I do. And the other day, I had to do something with the kids to get their social. I had no idea what it was. And my wife rattled off mine. And then she was able to rattle off most of the kids' numbers. But
your wife could, by memory, the kids' numbers too. Wow.
Yeah.
Wow. I know sick. Mine, and I actually know my wife's, believe it or not, because we've used it enough. But the kids, no. I actually have to look at my last year's tax returns that has them listed. That's how I find them.
Well, that's not bad.
I just pull them.
So, you know, part of my job, a big part of my job is retirement income planning. That's mostly what I do. And and Social Security is a big part of that. And it always comes down to this, really. When I run the Social Security maximization report, very popular.
Yeah.
I get people calling a lot on the show. And if you're listening and watching right now and you want your own Social Security maximization report, let us know. Just you'll see the contact information at the end.
Well, it is huge. It's a great value because you'll meet with them and run it for them at no charge. And it's unbelievable. It will find that sweet spot for you. It runs over 20,000 calculations to figure out the best time to file for you and your spouse with spousal benefits or you individually. It's awesome.
And rarely is it taken at 62, but that's what people like to do. So not combative, but we get into discussions about, well, does that really make sense? And if so, how am I going to live, right? Where's the money? How am I going to pay the bills if I don't take Social Security? That's why I want the money, right? Bird in the hand is worth two in the bush.
Right.
So I want to talk about that today. And I have about 6 different factors to consider. And I want to talk about what they are.
Okay.
And I think, generally speaking, it makes sense to delay, but I'll tell you why.
Okay.
So the first factor is life expectancy, Tony. So if you live long enough, will you benefit? I mean, it all depends on how long you're going to live. If you're not going to live a long life, say you expect to pass away at age 70, then obviously it doesn't make sense to delay Social Security until 70 because you'll never see a check.
True. Right.
So people get that, right? If you're going to die early, then you should take Social Security early because there's no death benefit with Social Security.
Mm-hmm.
It doesn't keep going to your kids or named beneficiary. So if you live an average life, then it doesn't quite matter when you take Social Security. If you're going to live to what Social Security has determined your life expectancy, and let's just call it 81 or 82.
Mm-hmm.
If you're going to live to age 82 and you're currently 62, if you take it at 62 or you take it at 70, the math comes out to be the same.
Wow.
Social Security, that's what the whole point is. Social Security is not trying to make money or figure out a
Yeah.
way to get people. They're just saying, hey, we're going to pay out this much. The actuaries say you're going to die in this year. So if you wait, we'll give you more because you're going to get it for less years. If you take it early, we're going to give you less because you're going to get it for more years.
Yep.
It's only when you deviate from the average life expectancy that it truly matters when you take Social
It's
Security.
all about the math, right? I mean, my grandfather is 101. He's still alive. So
Right. So he should have delayed to 70 had he known.
yeah. I don't know if he did or not. He was a farmer, so I don't know if he paid in very much. You know what I mean? That's the that's the catch there for people who are farmers or
Right.
in that type of occupation. He didn't work for an employer where he had they weren't they weren't putting in 6% and he wasn't putting in.
He wasn't getting a match for getting up early and then doing some hay bales or something,
Right.
picking the soybeans. Yeah. So this one's obviously the biggest and most important one, life expectancy.
Right.
How long are you going to live?
Yeah.
Right.
Right.
But then again, it's really only truly the biggest and most important one if you're single. Because as soon as you get married, now there's another factor in here.
Therein lies the catch. And this is where you lose most people. This is what most people never consider, right?
It depends.
Yeah.
It depends. In the beginning of Social Security, yeah, it was man works, woman does not work. Man takes it pension at 55, takes Social Security at 62, dies at 67, is happy he took it at 62, right? Wife still alive, not happy because she loses her own benefit and you can only keep one. So, and she keeps what he was getting as opposed to the higher amount if the spouse delayed. Now, with married couples, a lot earning similar earnings. Now there's a little bit more math. But yes, if you're married, you have to factor in spousal benefits.
Yeah.
So if you don't have a record and your spouse does, you want half of their record. That's
Right.
Spousal benefit. You get half. But you can't get half if they're not claimed, if they haven't filed yet. So if they're delaying and you want half, you're like, hey, can you file so I can claim? And what you used to be able to do is file and then suspend. Say, file, now my spouse can get half, and now I suspend. Now I don't want to do that. I mean, you can't do that anymore.
File and suspend, they got rid of that loophole. Yeah.
Right. So now it's, in order for your spouse to get half, you have to be filed. So that's not very useful.
No.
So maybe that's a reason to file early. But then you factor in survivor benefits, and this is what I was talking about at the beginning of this in this section, is when you pass away, your spouse gets your full benefit. So you when you're married, you want one of your benefits to really max out, not necessarily protect you, but maybe protect your spouse.
Right. You don't want to leave your loved one, your husband or wife, in a bad situation, but just because, I want to file early, get as much as I can, but then after you pass, they'll be stuck with a lower amount, is what you're saying.
Right. Let's use a very severe example to illustrate this. Let's say you're 62 and you want to file, and your wife is 62 and she has zero Social Security benefit. She never worked. So you are the primary breadwinner and you are convinced you're going to die at 72. Everything in the math says you should take it now, right? But your wife's parents are still alive at age 100, doing well, and she's got the genes that are going to suggest she's going to live well past 100. So what do? If you take it now, you're locking in a low benefit for your spouse, fundamentally.
For the rest
You're
of
also
her
locking
life.
in a low benefit for yourself. So if you just took your own self in a silo, yeah, it makes sense. Take it at 62 if you're going to be dead at 70. But your spouse, if it's going to live to 100 and she's got no other benefit, then you're going to want to delay to 70.
Yeah.
Even though you'll only see one or two checks, right?
Right.
So reason to delay, but this isn't addressing the issue is, well, what happens next? How do I live? Do I take my Social Security late and then take from an IRA? Right? That's really the question we're going to answer. But we have to address those first two to really get an understanding. Like, it's not all about the money sometimes for yourself. You have to factor in your spouse. So let's talk about one that is probably the most popular reason people take it early is because, hey, I'll take it early because it's my money. I get to do something with it. There's no death benefit. Hey, Social Security can go bankrupt. At least I got some money. Or I'd rather have it now because I can invest it. I don't even need it. I'll take that money, invest it, and do better than the government. And so that's opportunity cost. Because if you don't take it at 62 and you wait till 70, say, that's 8 years of no income that you would have gotten. You could use that to pay off debts, to reinvest. So the question is, what could you do with that money? What kind of investment returns could you get on that?
Right.
And
but you're still getting a return. You might be getting a better investment return by leaving it and get more return on your money by leaving it because it does roll up every year.
That's right. You do get the increase. So the longer you delay, the more money you get.
Right.
And that's very important because you do get a guaranteed rate of increase. You know what it's going to be because Social Security has, the actuaries have planned it out. If you're going to live the set, average lifespan, then it doesn't matter. Again, same thing. But someone would say, okay, if I lived to 82 and I took it early, I got 8 years worth of income that I reinvested and I did well. And yes, so that is true, but you also are getting less now, and the increase between, say, 67 and 70 is 8% a year. We know that. So, but you're right, there's the opportunity cost. So I could see where people get hung up on this. And it simply comes down to, first of all, what kind of investment return are you going to get?
Right.
You know what you're going to get with Social Security because it's guaranteed. What if
you put it in the market to try to outdo what you would have gotten and to try to grow it, you could do really well. Or when you finally need the money, it could be 2022 and the market's down 20% or 10%.
Exactly.
So then you lost money.
Then you actually lost money. So if you're going to take from your IRA in order to delay Social Security, the reason you'd be taking from your IRA or 401k is because you obviously need that money to live. So you're not investing that.
That's true.
Spending it, right? So that's the first argument against delay, against taking it early, is you're actually spending it anyway. But at the same token, someone would say, well, what if I left it there? It would still grow. I spend Social Security because that's not going to grow. And that other investment in my IRA is going to grow over 8 years. So I see that, right? But again, we're talking about income versus investment. We're talking about guarantee versus unknowns.
Because most people who take it early, are they really going to take it early and then make sure they put all that money into the market or into an investment and let it grow? Or are they going to spend it, use it they're going to get that money each month and spend it more than likely.
Right. But you can make the argument, okay, instead of spending it and taking it from my IRA, I'll take it from the Social Security, spend that money, and then leave the money I was going to spend in my IRA to grow.
Yeah.
But then it's just like, well, the money in Social Security was going to grow, but I don't get that right away. I get that over the lifetime. It's delayed gratification. So then it goes back to, well, are you married? Does that benefit both your lifetimes? And then what are you going to do? Are you going to invest it safely? Because right now you can get 4% maybe, right? And then we're talking June, or what are we in August, September of 2022? Geez, I don't even know what year it is now anymore. We've been doing the show so long. But can you get a guaranteed, 4%? That's a lot better than last year when getting a guaranteed 2% was good. So eventually maybe 8% isn't so great. Right? So back in the 80s, when interest rates, mortgage rates were 12%, maybe it was, hey, take it now because you can actually buy a CD and get a better return, right? So there's no set answer here. But opportunity cost is a big one. And I would argue, well, you got a guarantee versus a risk.
Yeah.
Okay.
So you do, the great thing is the report that you run and the benefit of working with a financial services professional and advisor like yourself is that you actually think through all these scenarios based on their individual situation or a couple's situation, if they're a couple, and then help them make that decision by doing the math. And because this gets too complicated for people to keep track of all these threads and actually remember to take all of this into account. And that's why you don't want to go it on your own. I'm just saying, I think that's a good point we need to make here, whether they work with you or another trusted professional who's going to help them with this, although most financial professionals won't help you with all these different strategies regarding Social Security because they don't make money off of that. So they don't. But you help your clients with this because you want to help you see the big picture. I mean, I think you should change your name, Dan, from Dolphin Financial to Dan Wendell's Holistic Financial Agency. That's what you should change. Dan Wendell's Holistic Financial Agency.
It's catchy.
Yeah.
Wow. It rolls off the tongue. No, but you're right. Most advisors, and I don't say most, a lot of the time, the conventional wisdom is take it early.
Yeah.
But again, that prevents the client from spending down their assets, which is what we're charging a fee on. So factor that in.
Ah, okay. I see
right?
the point. I see the thinking there
So
too. Yeah.
when I tell people to delay and spend their IRA money, that's actually reducing my fee, right?
Mm-hmm. But in some cases, you have done that. In some cases, you say it is smart to delay.
But again, it's people get really adamant about these decisions. And when I say, hey, we're going to delay and pull from an IRA, people don't like seeing their account balance go down because you don't see Social Security. It's nebulous, right?
Yeah.
Here's another point. Legacy. People don't like, well, if I spend down my IRA, what are my kids going to get? Right? What are my grandkids going to get? Whereas if I spend Social Security, they're not going to get it anyway. So I'd rather spend Social Security than my IRA. It's a good point.
That's a good argument.
It's a good point. But when you start doing some math, again, going back to the first, what's your life expectancy? Are you married? If you start doing some math, you'll see later in life, if you live to the ages where most people are living now in their 80s, even into the 90s, you'll start to see that delaying actually makes more sense. You end up with a larger nest egg later because of some other factors, such as pulling and letting things grow and not needing as much because you have a larger portion coming from Social Security with the cost of living, right? So the idea, but if you just if you just stop there and say, well, I can invest it elsewhere, I can leave it to my kids, then yeah, it really is attractive to take Social Security early and not delay. But when we start factoring in these next few, there's two more I want to talk about. Okay. All of a sudden, you're like, wait, now I really have to. So this is why you're right, holistic. Here's one that this is relatively new, and I say relatively, I'd say within the past 12 years, when we started getting subsidies for health insurance from the government. This is for people under age 65, not on Medicare. They get a health insurance subsidy based on their income, not on their assets. Okay. Right. So you can have trillions in the IRA and still get a subsidy because you don't have any income. So when you take Social Security early, you're taking income. You can't control it. You're getting it, and you're increasing the income you have, thereby reducing your subsidy. So by delaying Social Security, you can then use other sources to get income. Doesn't show as income. You get a higher subsidy to pay for health insurance. This could be huge because the health insurance subsidies can be tens of thousands of dollars a year, depending on the situation. True. And as you get closer to 65, health insurance gets more expensive. So health insurance subsidy planning is a factor when it comes to when to claim Social Security, believe it or not. Mm-hmm. But it's for a small majority of people.
Right, because that's only before you turn 65. So, yeah.
Right. I should say a small minority of people. Not too many people are in that. But we're talking people typically age 62 to 65. They're the only ones that can claim Social Security and not be on Medicare, right?
Right.
But here's the big one, Tony. This is by far and away the biggest factor is taxes.
I knew this was coming. How did I know taxes played a role in this?
And it's amazing how big taxes factor into Social Security planning. And so when you're having a discussion about when to take Social Security, it's not just about life expectancy and income. It's about taxes. And in many ways. First of all, you have taxes on the Social Security. So it's important to note that when you're determining how much of your Social Security benefit is taxable, there's these limits. All right. It's, is it 24,000, 32,000, 44,000, right? Depends on you married or not. But these are the conversations I have with people. And it's like, well, that's not a lot, but it's how much of your Social Security benefit is taxable is based on your provisional income. Provisional income. Well, what is that? That's a new term. Well, it is, because you never really deal with it. Provisional income is your income, and Social Security, only half of your Social Security benefit counts toward provisional income. So if you make 40,000 in Social Security benefit, your provisional income is only 20,000. So that's how they determine how much of it is taxable. So you're like, oh, so in other words, the more you have in Social Security income, the less you're going to get taxed, the less of it's going to get taxed. As soon as you add a pension, or if you have other income, then yeah. But it's important that people realize that. So by delaying Social Security early on, you're not going to pay any tax on it. Later on, when you get a larger benefit, only half of it counts as income for taxation purposes on Social Security. That's an important concept. It's confusing, but important to note.
Yeah, and we've done shows talking about how Social Security is taxable. People don't realize that.
I'll put that up there.
Yeah.
We do a lot of those shows on that.
Yeah, exactly.
And which brings it up
to 80%, 85%.
85. Which brings, right. So I'd rather have $1 of Social Security income than $1 of regular income. Whether you pull it from an IRA or it's just revenue from an employer, I'd rather have Social Security income.
Less than regular income.
Exactly. Even if you make the max income, only 85% of your benefits are taxed.
You're saving 15 cents on a dollar.
Right. So which leads me to say delay, because you get a higher portion of your income from Social Security later, and only 85% of that's going to be taxable at the most. Maybe none of it will be taxed.
Yeah.
So that's the tax portion on income taxes and Social Security taxes. Then we have RMDs. Required minimum distributions start at age 72. That is, they look at all of your IRAs, 401ks, any qualified money, and say, you never pay tax on it. I know you've been delaying it, but we want you to start taking it. And here's how we do it. Based on your age formula, this is what you have to take. Okay. What does this have to do with Social Security, delaying Social Security? Well, the whole point of the show is if you delay Social Security, you need to live, you pull money from your IRA, you're thereby reducing your IRA. I don't want to reduce my IRA. I would like money. Well, you're paying the taxes now, and then when you hit 72 and they calculate your RMD, you have less in your IRA. Well, I don't mind paying taxes because that means I have more in my IRA. Yeah, but you have more income coming from Social Security, so you have less in your IRA. You're forced to pull less out, thereby reducing your tax liability later.
There you go. When taxes might be higher. Yeah.
Which brings it to the next point, which is Roth conversions are huge because you're taking money out of an IRA, paying the taxes now, and then you don't have to pay taxes again. You don't have to take RMDs from a Roth.
Right.
So the idea is, don't take Social Security right away. Take as much as you can from the IRA. Well, I don't need all of it. Take it anyway, up to the next tax bracket, convert it, and now it's sitting in a tax-free account. So you could take that, be strategic about it. But if you're claiming Social Security at 62 or early, now all of a sudden you have 30,000 or 40,000 of income from Social Security, and you're like, oh, I can't convert because I got this income, and you're raising your taxes on Social Security. You can convert less because you're already at the higher tax bracket. Reason alone, RMD and Roth conversions. It's bottom line, Tony. There's a lot of tax reasons on it. Plus, your future tax liability is going to be less because you don't have to take RMDs. Your Roth will be higher, and that's tax-free, and you could be in more control. When is the time to really consider Roth conversions? When your tax bracket's the lowest. Tax brackets are pretty low right now. The other time to consider is when your income is low, when people retire. So they retire at 62, instead of taking from the Social Security, why not pull from the IRA and convert and spend and then delay, right? Then take Social Security later.
Makes sense.
So to conclude, because there's a lot of factors in there, we talked about them, but taxes are the biggest. And I don't like the tax tail wagging the dog, but I do think that a Social Security delay is a tax discussion. You should be factoring in.
Everything regarding retirement income is a tax discussion.
Yes. Especially
everything.
Because the IRS is involved in your IRA and your RMD.
All your investments, all your savings, and especially your retirement accounts, 401ks, 403bs, IRAs, Roth IRAs, they all have tax implications, good and bad. So it's like every episode we have to mention taxes pretty much because they play a role.
Yeah. And, when I do these Social Security maximization reports and it says you delay to 70 and you take it at 62, people see the numbers, right? So it's like, and they're all projections, right? But we see the numbers and say, oh, look at that. We'll get $150,000 more over the lifetime if we do this strategy versus the one we're thinking. And it's usually delay because we were thinking about taking it early. And on paper, it makes sense. But then people say, well, yeah, but, right? And so that but is a really good conversation. And a lot of times we say, yeah, it does make sense on paper, but we're not going to delay for these reasons. Maybe we want to do more spending up front. But then it's like, wait, what about a conversion? What about, spending more in the beginning, but and then by doing spending in the beginning from an IRA, oh my gosh, the IRA goes down really quick, but then it levels off. If you spend early, and you keep going, because you have to, then your account will go to zero. But if you spend early and then level off, that's the whole point. So it's difficult to express in a podcast format. It's a lot easier in person when you're looking at your specifics and showing the chart and say,
when you're sitting across from the table from them, showing them here it is, or up on a screen, here's the chart, and then go through it together and look at the numbers together and talk about life expectancies and strategies. It makes a world of difference. And the whole COVID thing, you're able to interact with people virtually, but it does make a difference when you can talk to them one-on-one, especially in person, but even virtually, one-on-one. It's hard to do in a podcast though, because it's so much personalized information that you need, right?
Yeah. And I'll leave it. It does but once you put in their personal information, it's relevant. It's not just hypothetical of, well, the average person. So no, this is your Social Security record.
Right.
This shows you your benefits, your spouse's situation. And I'll leave you with, it's kind of like an analogy. Right now, we're facing a crisis in the country with debt, right? And we all know that foregoing stuff now would benefit us in the future. But it's so appealing to spend now, right? It's the same thing.
We've got that ingrained. It's human nature to want it now. I want it now. Yeah.
Right. So all the math and all the charts will show you, hey, maybe it makes sense for you to delay. But again, you got to get past that hump. But once you throw taxes in there, that's when you get pushed over the top. You're like, oh, I can delay and I can benefit me instead of the IRS. Maybe let's talk. Right. So again, though, it's a very complex issue. I mean, we could probably talk for hours on this. Or at least I could.
I think we have. I mean, not just today, but
not today. Right. I could probably go on, but yeah, that's it, Tony. I want to say, and again, people, if you're thinking about Social Security and you're like, this guy talking about delaying, because that's the new thing now. More and more people. I remember when I started talking about delaying, no one did. was always take it early. Now
Right.
more and more people are wising up to it. More fiduciaries out there are saying, yeah, I need to know this. And so they're delaying it. So if you're thinking, you're like, you know what, I just need to see it on paper, give us a call. Let us know. I'll put the phone number up in a minute. Tony, thanks for a good show.
God bless Social Security.
God bless Social Security.
Dan
All matters
Wendell.
discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Wendell nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.